This is the market comment for Friday, January 19th by Raf Boyajian. I'm Cristina Marujos, and thank you for joining us here at XM.com. AI mania made a comeback on Thursday as optimism about a recovery in AI-related demand, as well as the broader tech sector, boosted equity markets. Apple and TSMC were the main catalysts for yesterday's rally, ending a two-day rout on Wall Street and lifting sentiment ahead of the big tech earnings coming up next week. Apple shares notched up their biggest daily rise since last May, while chip giant Taiwan Semiconductor Manufacturing Company saw its stock surge in both New York and Taiwan. The Nasdaq 100 advanced by 1.5% to close at a new peak. The S&P 500 came within a whisker of setting a new record. The rally in global equities comes even as investors have started to scale back some of their very dovish bets about the interest rate outlook in the United States and elsewhere. The latest rally shows that tech and AI stocks have the ability to decouple themselves from the usual risk factors driving the markets, and their defensive nature will likely be put to the test should Fed rate cut bets continue to be trimmed. Investors now see just more than a 50% probability of the Fed cutting rates in March. U.S. and European bond yields have been creeping up all week as policymakers from the Fed and European Central Bank repeatedly pushed back on the market's timeline of how soon rates would be cut. The 10-year Treasury yield is currently trading one-month highs, lifting the U.S. dollar to similar highs against a basket of currencies. But after falling sharply at the start of the week, the euro has managed to stabilize around $108.80. However, sterling, which was boosted midweek from a hot UK CPI report, has come under pressure on Friday following a much worse than expected drop in retail sales in December. Investors also digested the latest CPI figures out of Japan today. Consumer prices rose by 2.3% year-on-year in December, and whilst the data was in line with expectations, the yen skidded in the immediate aftermath as it added to the doubts about the Bank of Japan being able to hike interest rates anytime soon. This prompted some verbal intervention from Japan's finance minister, triggering a reversal in the yen's decline. Thanks for watching today's market comment at XM.com. Have a great weekend.